What up, homies? I was looking for the date because it's the 18th of July. It's July 18th. It's Tuesday, July 18th, 1 p.m. on the East Coast. Dan Nathan, Guy Adami. Check this out. In just a few minutes, probably less than that, Dan, Carter Braxton Worth from Worth Charting will be jumping on the line. I am fired up. Today's market call brought to you by CME Group, Dan, where risk meets opportunity. Listen, I'm not Laird Hamilton, doing that surfing shit because that's badass. I wish I could. Although I was one of the early people at Mavericks. You might want to Google that. And also, of course, our data provider, Dan, is FactSet, financial data and analytics powered by tomorrow. So it's Tuesday. The market's higher because, of course, it's open. And here we are, Microsoft just off to the races on yet another AI thing. I'm not going to bury the lead, but Doug Cass sent an email to us both and illustrating how some of the absurdities that's going on, how the market's being driven by a handful of stocks, and how AI names have accounted for the lion's share, if not the entirety of this move. And he's right. But here we are at 55.43 in the S&P 500.
Well, all right, let's take a step back here.
I'm stepping back.
Yeah, let's talk about what's going on in Microsoft. The headline today, they have pricing of their Office 365, the Copilot. This is this like suite of tools that is based on OpenAI. This is the company that they invested in, right? The ChatGPT, that they're integrating into their productivity tools, into their search and Bing, and people are really excited about. And I just want to make one point here. Okay, so if the stock is up 5% in a straight line on the day on that headline to a new all-time high, let's just do some math here. Okay, this is a $2.6 trillion market cap company. Okay, so Guy, 10% would be $260 billion. Okay, 5% is $130 billion. Okay,
nice
so
job.
The stock has gained $130 billion in market cap in a straight line in an hour and a half because of a headline that everyone expected. Okay, maybe the pricing was $5 more per user, you know what I mean, per seat, that sort of thing. But think about this. Okay, this is a company that this year is expected to do in revenue, okay, $211 billion. The CFO of this company, Amy Hood, said recently, I think to analysts or something, that this basically their AI tools are going to be their fastest business ever to $10 billion in revenue. Okay, so I just said that the stock has just gained $130 billion in market capitalization off of maybe a business right now that they might gain $10 billion in revenue for. So today's move is 1.3 or 10, it's 13 times. I mean, think about that. Okay, so that's crazy. That was just like some little simple math. So you tell me what sort of investment world that we're living in right now where that can happen and take a stock like this to a new all-time high, trading at 38 times this year's expected earnings of high single digit, next year's 33%, or 33 times next year's expected earnings growth. I don't know, man.
Quite frankly, we've seen this investing world before. I mean, I don't want to get too draconian here, but I mean, you saw some pretty crazy moves in the late 1920s, by the way, number one, but I don't even want to necessarily go there. I mean, you saw the same type of stuff going on in the late 90s, early aughts, as they say. So it's not like it's unprecedented. And to a certain extent, in other asset classes, you saw the same type of stuff going on 06, 07 into 08. So it's not like it has not happened before. And when you see Microsoft, which again just made an all-time high today, for context, an all-time high today against a quarter last quarter, which was by Microsoft standards okay. I mean, this AI thing clearly has vaulted them, to the point I made earlier about what Doug sent us, into the stratosphere. I don't think this is necessarily human beings making these decisions, but that doesn't even matter anymore because it is a machine-based, machine-driven, headline-driven market. And with passive investing, money flows are such that these stocks are going to move. I think when people realize the fundamentals behind it and the valuations now that Microsoft is probably trading at, and I have to do a back of an envelope, but given this move, I would submit Microsoft is probably close to 31 times next year's numbers.
33.
30, what was it? I'm sorry. 33. So think about that. That's probably, well, I could probably say this with a lot of confidence. It's the highest multiple we've seen in the last decade. I can't speak to the lifetime of Microsoft, but I don't think it's necessarily justified. Now, it doesn't matter what I think. If you're long the stock, it doesn't matter the reasons why it's higher. You're making money. But just understand, don't confuse brilliance of investing with markets that are now divorced themselves from reality. And by the way, I am absolutely choosing that phrase.
Yeah, well, and I would also add, maybe the guys can pull up an intraday chart of NVIDIA, and NVIDIA was down in the day, and now it's up 2%. And so when you think about this, like, this is really important. So we talked about maybe that's going to be $10 billion in revenue for that product, right, for Microsoft. And so it's trading at 13 times, like the market cap gain is 13 times that best case scenario, not best case, but like good case scenario sales. Well, think about what also has to do. If Microsoft's rolling out these products and they're charging $30 per user enterprise customer, right, for that, they also better nail it. They better have the proper chips and supercomputers and data centers to run those searches, right? And that's all going to be really expensive. And that's why I think, obviously, NVIDIA is rallying off of this news. Again, it just reinforces the fact that people are going to need these graphics chips to put in those sorts of, supercomputers for the compute and everything like that. But it's also expensive. And so if that $10 billion in sales comes with much greater costs, right, then I'm not certain it's a layup here either. So again, I'm just ranting here a little bit. This doesn't make a whole heck of a lot of sense for me. I think if you're buying these stocks off this, and if you're anything other than a momentum trader, fine. I mean, like, we all used to trade like this. I used to trade like this all the time. And but now we sit and talk about this stuff, whether it be on our podcast or on Market Call or on Fast Money. We got to talk about it every day. So I guess maybe we're just getting a little ranty, as crazy as
it gets, and I'm sure people are tired of hearing us seemingly rage against the machine. And then people, what I will say is, given the amount of time I've been doing this and living through some of these things, I'd like to think I know how this ends. And I'm not suggesting we're trying to protect people from themselves, because that's really patronizing. And it's almost sort of, I think it's somewhat insulting. But, with the, I guess, under the context of having lived through this, I think there's some warning signs that absolutely need to be addressed. And I'm not going to say it's easy to sit here and be bullish every day, because if it were that easy, I probably would have done it. But it's also, with that said, I don't think you're doing anybody a great service if you don't point out, again, some of the irregularities and some of the absurdities of what's going on. And my concern is, when this turns and all those zero data expiry options, which are clearly being utilized in a bullish way, start being utilized in a bearish way, and you see how quickly things can go down, there will be a cascade of people. I know this because I've lived through this as well, raging against the media and us specifically, saying, why didn't you warn us? Why didn't you tell us? So, I guess forewarned is forearmed type of thing. But on days like today, nobody really necessarily wants to hear it. And I understand that.
Yeah. Times like these, we learn to love again, guy.
What was that? Right. Is that we did Neil Young yesterday on our radio? That's not Neil Young, though.
That was great. No, that's Foo Fighters.
I love. Aren't they being inducted into some Hall of Fame, or is
they should be if they're not? All right, let's do it, because like we're a little, at least I am. I'm a little ranty. Who's someone who never rants, who's always just a real rational guy. You know why? Because he doesn't get in the weeds of all that stuff, that math that we were doing and this and that or whatever. There's this what no emojis with hearts, just charts. Is that what we're doing?
No here? Emojis, no hearts. Oh, just charts. And if it, and it's interesting, because what's that woman, Britney Spears? Yeah. So Britney Spears wrote a song about it. This is what it would be. Sorry, Carter, just indulge me for a second. It's all good. It'd be like, no emojis, no hearts, just charts. I'm Britney, bitch. Back to you.
All right, Carter Braxton Worth.
Good. Look, there's never any point in ranting, right? Because the market doesn't know you own it or short it. In fact, we all have these issues. All my life, I would sometimes go into meetings in the past 30 years. You're presenting to a man or a woman who's running a $14, $20 billion fund, and they'll say something like, after you've recommended something, I can't buy that. You're like, they go, I can't buy that. I lost money 3 times in that one. I mean, the point is that we all, sometimes you personalize and you think, this damn stock, I can never. But at the end of the day, it is just over time a process trying to profit where we can, when we can, and control losses. But here, just in line with what you're talking about, consider this. This came in from a client, portfolio manager. He said this thing, TTD, Trade Desk, right? Just being added to the NASDAQ 100, right, with a $42 billion market cap. And as he writes here, GAAP earnings have fallen by 80% over the past 3 years, from 240 million to 53. Stock-based comp has gone up to 1 billion from 100 million, right? And it doesn't generate any free cash flow, excluding stock-based comp. So here you have something that's 40 billion added to the Nasdaq 100. Now, of course, that's the past. In the future, they could earn great sums, but the highest earnings they've ever had per share is about 50 cents. They're projected to maybe make $1 in the 12 to 18 months ahead, and trading at $88 added to the Nasdaq 100. Is that a long-term, you buy it here, are you going to be ahead or behind looking out 3 to 5 years? I think you'll be behind.
Yeah, well, I think that's kind of a theme of at least my ranting here a little bit, is that there's a lot of enthusiasm about narratives right now. And I think, Guy, that was kind of the point you were making about those other periods in time in the markets, because narratives, are very powerful, right? Storytelling is very powerful. And especially when you're dealing with technology companies where, we can't really even figure out how the best uses of a lot of this AI, these large language models, the generative AI, what they're actually going to be when they're commercialized, really commercialized. And that's the lesson, I think, of the internet bubble in the late 90s. But the S&P 500 averaged 30% gains from 95 through 99. You know what I mean? And you could have been railing against it the whole time. I guess what I'm saying here is why I just thought, Carter, it made a lot of sense to look at this. The CFO of this company said this is going to be the quickest thing to 10 billion, and the stock has just gained 130 billion on the headline about the pricing of this thing, but no one knows what the revenue, what it's going to be and what sort of margin they have on it, given all the expense it costs to get there. So here it is what it is. Let's talk about a sector that I think is really interesting, because before this headline came out, guys, if you recall, a lot of these stocks, the semi stocks that have been benefiting from AI, Google, Amazon, all these stocks were down on the day. And what was raging were the bank stocks. And so, there's one where there actually have been, really negative sentiment, and they've underperformed the broad market. So, Carter, when you see a move like we have today in Schwab, Danny Moses was just in here, our pod partner on the tape, and he was like, you see this thing? You see this thing? I don't know. He's like, I don't know what they said. You know what I mean? I'm not saying he doesn't know what they said, but it wasn't like a 12%, sort of thing. It wasn't like the sort of beat and raise. So look at that. It just got above its 150 day. It broke out here, or broke out, above it, I guess. Thoughts there. And then maybe if you want to take a look, I think we have a KRE, which is the regional banking index. We have an XLF here. Are they getting more constructive in your opinion?
Yeah, just per chance. I don't know if intended as such, but per this conversation, Friday's closing note of the week was buy BKX for a bounce. And all it was based on was the minor formation, simply the formation. And you can see it here. It's a sloppy head and shoulders bottom, but you can see it in the KRE very clearly, and you can see it in the BKX. And the trade would be simply doing what Schwab has now done, getting back to trend, getting back to the 150-day moving average. And so we started out of the gate with the first earnings. JP Morgan was the only one that was good. Everyone else was down. Big hits on State Street, right? Northern Trust. But with BAC's news and strength today, the thesis, the trade is very much intact. So from my seat, you make it to 49, 45 here. That's a nice 10% trade, and you take the money and run. Structurally, look, banks are a bad business. Let me just consider this. The relative performance of the BKX since making all-time lows, substantially below its 2009 financial crisis relative lows. Or another stat just for fun, Morgan Stanley, which is a great business in principle, is trading at the same level it was in 2000. So now we're 2023. If you were to see an all data chart of Morgan Stanley, you're talking about something that's unchanged for 23 years, which means adjusted for inflation at 3 to 4% a year, you've lost 80% of your money. 80% of your money owning Morgan Stanley if you're just sitting around holding it on a real terms basis. So there it is. Current price is exactly at the level of the dot-com peak. That's pathetic.
Yeah, and I agree with you. We put the KRE back real quick. And again, I'm not going to pretend I've been some raging bull because I haven't. What I've said for a while is in the absence of headline news, these things will continue to levitate. And these things meaning the regional banks. And that's what's happening. I've also said I think there's going to be an inevitability to another swath of bad news. And it's just a question of at what point in this chart does it happen. So this thing will continue to sort of do this dance. I think Carter's right. You get back to that very steep downtrend line in the form of the moving average, then you have to ask yourself a question. And by the way, at a certain point, the compelling valuation that these banks had back in March, April, May are going to start to sort of wane, and that valuation starts to become a headwind, especially when you consider, and we're going to talk to Sheila Bair on Fast Money tonight. I would tune in for that. Regulation is coming. Tightening credit conditions are coming. The access to credit's not going to be there. The appetite for credit's not going to be there. And when you think about it, regional banks in this environment have a giant bullseye on their back. So I think you can continue to sort of ride this wave, but understand that this is going to crash on the beach at some point. And I think it's going to happen faster than people realize.
All right, let's talk about yields, because I think it's interesting, Carter. I think there was a time in the not so distant past where you were saying that, the 10-year yield, it looked like a pair of twos. And I think the way it's traded over the last few weeks has kind of suggested that too, right? It had moved to the kind of downtrend that had been in place, and it's kind of held that moving average over the last year, 150 or whatever. But look at that. It's like kind of right dead in the middle here. If we're looking out again to this FOMC meeting on July 26th, we have a near certainty, at least that what the CME Fed funds tracker is pricing, another 25 basis point sort of hike here. I think that a couple weeks ago when they had that pretty sharp move in yields, I think a lot of folks thought that maybe that had to do with the Fed's hawkish stance, that maybe that hawkish pause in the June meeting, if we saw maybe a reacceleration in some data that was hot, right? That we might have a Fed that has to get back on the horse. Thoughts here on yields and how we should be thinking about them relative to equities. And do you think we're setting up for maybe a big move as kind of a breakout or a breakdown, at least a retest of that uptrend that's been in place for last year in the 10-year?
Right. So I remain in the lower rates camp. Just to go back to the peak, that was a Friday. It was October 21st of 2022. The dollar peaked in September. 1 month later, yields peaked. And so the 5-year, the 10-year, and 30 yields have never exceeded those highs. That's 9 months ago and counting. Rates basically have been peaking, in my view, for now, 9 months. You can see here, this was a piece put out today. So those peaks, October 21st of 2022, that's a typo. Look at that on my thing, because we know that October 21st, 2023 does not exist yet. But the point being that 9 months later, rates are still below where they were. And I think we basically work lower. And the tell is that the dollar never looked back, right? The dollar peaked right around the same time, 3 weeks, and then has gone straight down.
Let's put that chart back up in yields real quick. If we could toggle back, bingo players, you're welcome. This has me, well, it's interesting. Clearly, I'm confused. I think that's a foregone conclusion. But you know what else is confused, Dan? The bond market seemingly is extraordinarily confused as well. And it comes in the form of some of these moves we've seen over the last couple of weeks. Again, bond volatility seems to be back. And I think there's a struggle with what's going on here. Is inflation still a problem? Is slowing growth a problem? Quite frankly, I think both of those are a problem, which is why the bond market continues to try to figure it out. What I've been puzzled by, and I'll say it for the 100th time, is bond market volatility has not found its way into the equity market. And again, I would just say it's a matter of time before it does. I thought 10-year yields would go lower as well. The reason why I thought they'd go lower, Dan, is because, one, I thought that the economy is slowing, which it probably is. And two, I thought the broader market would sell off and you'd have a flight to quality in the form of the treasury market, which makes yields go lower. Neither one of those things has happened. But, here we are, and you go across back to, again, late fall. And yeah, we've had some pretty significant moves, but we're basically at the same levels we were, I want to say, around Thanksgiving, Dan.
Yeah. Well, it's interesting. And one of the things that you and I spent some time talking about on the tape, and then we also did Market Call yesterday on Sirius XM.
Sure we did.
Business Radio 132 at noon Eastern, people. But we talked a little bit about the move in the dollar. I mean, man, over the last kind of 2 weeks or so, That was, talking about like volatility working its way into other asset classes. I mean, we're starting to see some bond market volatility. We're starting to see some volatility in the currency markets. We're starting to see some volatility in overseas markets, the Chinese markets, and the equity markets don't act particularly well. So it'll be interesting to see where else it gets to. But this got us to something that, Guy, is near and dear to your heart. And Carter had a great post on Worth Charting today, and we suggest you guys all check it out. But he's going to walk us through it here a little bit. With this dollar weakness, the shiny metal, it looks like something that it feels fairly constructive. So Carter, walk us through what you're seeing, and believe it or not, Guy Adami wants to put a trade on in gold using the futures here when you're done. And I think we're going to kind of line it up with some of your levels there too, buddy.
Sure. So, I mean, commodities in general, right? We know crude is perked up, nat gas. And you look at whether it's the CRB or there's an ETF, GSG, they all look tradable here on the long side. But gold, basically a 6-month chart, no lines, no drawings, no judgments. Let's put some on. Does it have to be that? No, that's a conclusion. That's a judgment. But that's what my eye sees. Look at the next one. Downtrend line. Put them together. Okay. But now let's look at this circumstance. That's about an 8 or 10% sell-off since May. Put it in the longer-term chart. So same thing. Look at the iterations. The first one, there's the little minor bottom. Next one. And so now keeping this same time frame and getting rid of those minor annotations, this is what really is important. We also know that the drawdown, where it stopped, look at the percent decline, right, was right to trend, about an 8%, not much different than the preceding drawdown of 8% in March. Put them together and you have that. And the longer term, of course, is what remains the compelling thing. Are we ultimately going to make important new highs? Gold is essentially at its 2011 peak. Here we are, 2023, and we've been setting up ultimately, I think, to take those highs out. Last iteration, and you see it here. So you can toggle back and forth those last two. The point being that this is a setup that is likely resolved up. And at this point, if you don't have gold, get some.
I love that gold bullion. It reminds me of soup, Dan. And listen, that I agree with this. And I think Carter would also say that each time if we were to flip this around, which we can't do, but if we were, you would say each time we traded down to support and held, typically the third time it does not hold. Well, the same holds true on the upside. So we've obviously made runs a couple times to this new all-time high and have failed. But here we are yet again on the precipice of doing exactly that. And at a certain point, you keep knocking on that door is going to open. And I think that's exactly what we're setting up for. And, if you want, we can go to the trade. I think we've outlined it. This is what I'm looking at right now. I think, and this is not in a vacuum. We've been talking about this. I think you get long gold effectively here. The stop out is basically that trend line. So that trend line that we've talked about for a while, that uptrend line that's been in place, that's where you're stopping out. Not a huge move to the downside. You didn't give yourself a lot of room, but I think that's the right level. On the upside, your initial target is that all-time high that we've been talking about. So you can put that prior chart up real quick just to sort of illustrate it a little bit better. This is what I will tell you, Dan and Carter. And again, I'm not suggesting I'm right, but having done this for a long time, I'll tell you what typically happens. As much as we talk about gold, and seemingly it's an everyday occurrence, for a lot of the investor verticals out there, it's not on anybody's radar screen necessarily. The big swaths of money right now are not focused on gold. They will be focused on gold when their system tells them to be, and their systems haven't kicked in yet. My sense is their systems kick in on a close above these prior all-time highs, which comes in right about that level that we flagged. So yeah. I think there's another leg left. That leg is going to be driven by institutional money coming in, which, by the way, it's great for the equity market because the equity market can typically take that type of liquidity. The gold market is not set up that way. The gold market is not nearly as large. So that's why I think you're about to see some outsized moves to the upside. So get long here. Your stop is the upper trend line. Your initial target is the all-time high, but I'm looking for much more than that, Dan.
Yeah, and so I think it's really interesting when I think about this trade here. So we have 1983, and if we look at kind of like right before that, kind of like that recent high, that target would be like 2060, and then about like 2080 guy, that was kind of those tops that we've seen over the last 3 years or so, and that's really, I think, the breakout that Carter is talking about here. But to the downside, it's funny, so we're at 1983, and I think the stop. This first stop is down about 2%, guy. It's down, 1945 or so. And you could stop it, that level down there. Maybe it's kind of, 1900 or so. That was the low, I think, from about a month ago. But, when you're trading futures, and you and I've talked about this, you want to use pretty tight stops here, because the ability to kind of probe for levels and continue to play for a move, that sort of thing, because things just don't always happen all at once here. And I think the idea of kind of allowing for, let's say, a 4% downside where your initial target is up about 4%, that's not particularly great. And so I think that the risk reward is kind of embedded, or it helped out by using tighter stops, in my opinion, because if the dollar continues to go lower, and let's say the equity markets sell off a little bit in doing so, you're going to have upward pressure on this, and then you would continue to kind of raise your stop, every 20 or 40 or something like that. So I like what, Carter, you're seeing in the charts, and Guy, I like the way you want to trade in the future.
Yeah, and before we turn it back over to you or Carter, I'll say this: people, I'm reading some of the comments, and people are making great points. And I've said this, but any new audience members, I think they should hear it. I think without doubt, I mean, this is just factually true. Central banks bought a record amount of gold last year. I think it was 1,131 tons, to the tune of about $71 billion or so dollars. And they're on pace to do similar this year. And what I've said, and what I absolutely believe, central banks are effectively hedging their own collective ineptitude. So that is being taken off the market as well. Now, I'm surprised the price hasn't been commensurate, that type of buying, with the price, but I also think it's just a matter of time. So the gold trade, to me, is alive and well. And I'd be very surprised if some event didn't trigger that institutional buying that I talked about a few minutes ago.
Yeah, Carter, let's talk a little bit about commodities. Let's broaden it out a little bit here, because Guy, you made a great point to me. I was gone all last week, and I was talking about this move in crude up to the mid 70s, and I thought it was really interesting because I was looking at my charts after not kind of looking at my FactSet screens for 5 days, and it was interesting that ExxonMobil, the largest component of the XLE, like the largest oil name out there, was trading at a 3-month low as crude just made this move from like 68 to 75 here. And it was kind of interesting. And Guy's point was, yeah, but for every large integrated that you have that's trading like that, look at what's going on in the oil services. So maybe you could help us a little bit with the commodity complex a little bit, and then we'll kind of work our way back into crude and maybe some of the related stocks.
Sure. I mean, nat gas has been basing and stabilizing week after week for many weeks, and crude got down to close to 60, and you had all these reports coming out: recession, crude to 40. They're the equal and opposite reports of when crude went to 140, and 2 Wall Street firms published $2.50 a barrel because of Ukraine. When Wall Street gets really convinced about something, the one thing history shows is you should take the opposite side. So when Wall Street says $2.50 a barrel, we're going to go from 140 to 250, get short crude. When Wall Street starts talking about 40, you want to get long crude. Now, crude commodities in general are starting to base and bottom. Here's the CRB. It's an all commodities index, but there are others. Look at the next iteration, whether we use the moving average or we use the trend line. The point is we are in the throes of a bottom. That's my view.
I agree with that. And, I'll throw just a couple things, Dan, and we're coming up on it, I know, but gasoline very quietly is moving higher. I think we're a multi-month high, by the way. And again, not to get too wonky, but gasoline is in a pretty steep backwardation. And this time of year, it's something we typically don't see. So keep that in mind. And a lot of these commodities have actually started to turn to the upside, to Carter's point. So I think, and we've talked about this, we talked about it on our podcast that dropped on Friday with Dennis DeBuscher. Yes, the same way I think you saw probably that peak inflation read of June of last year, whatever that was, 9.1%, I think it was June. You might have just seen the trough number, if not this past month, maybe this coming month, but you're pretty damn close. And I think you're going to start to see inflation start to trend the other way. And you have a seasonality thing going on. And by the way, the comps with which it's measured get easier. In other words, this is going to be much more difficult for that downward trajectory to continue. That's why, by the way, I think the Fed is being as hawkish as they are, because they intuitively understand that. So we'll see. That's obviously the bearish case for equities and those such things. It's also the bullish case, Dan, for commodities.
Yeah, no, and it's interesting because Carter, I think right before I left, right before that kind of July 4th week, you were saying to buy crude, and that support held, and it really propelled a fairly big move or so. And I think it's interesting to kind of overlay, nat gas as you did, and show some of the other, related commodities that are putting on bases, and they look like they're showing some support there. So pretty interesting. Guy, do you want to take a look quickly? There's going to be some of these oil service names that are reporting here.
Well, Halliburton for sure. Yeah. Let's throw up I don't know if we have an OIH chart. I'm sure we do, but we look at this move. I mean, this is flying under everybody's radar screen. Got down to about 247, 248 in early June, right? Basically approaching a 52-week high. We've driven the red line. I'm not suggesting it's right. Carter is probably making a face, but it is what it is. And you've had this stealth move in the services sector in a tape that's clearly gone higher, but against the backdrop of a commodity, to your point, that's really going nowhere. So the fundamentals are starting to take over here. And again, we're at I'll use the word again. I think we're at the precipice. We're sort of right at that point where these oil service names are going to break out. I think Halliburton, Dan, is after the bell tomorrow. I apologize if it's before. Regardless, that's obviously your first. There's your implied move. You've had a nice bounce. It looks hauntingly similar to the OIH chart, although it's not rallied as much. You could sort of see it there. I still think it has room to the upside. So my view on the OIH. The OIH is one of the O's in my mojo. Again, it doesn't matter which O, it is one of them. And I think this thing can then just doesn't grind in the back half of the year.
All right, here's one thing, Carter. I just want to freestyle for a second here.
Oh, I like that.
There was a name, and this is going back to last kind of earnings season, and I bought it after it gapped on the first day. And I'm not one of those people. Carter, do you have any sense? Like, you ever hear people say the 3-day rule? Like, if you have a stock that you wanted to buy and it gaps after earnings, like, is that a thing or no, in your opinion?
People sure want to believe it's a thing. Here's the thing. There's no hard and fast rules in this, right? We know that. What they're trying to say, because it's like, okay, how about, not to talk about DeMarc, but I mean, why is it 13? If something goes up practically every day for 12 days or 14 days, at some point it's overbought or oversold. Okay. So 30-day, it's a cooling off period. They do that when you buy handguns too. The idea is
actually, right? they don't. They don't.
Well, they should. Okay, but they do it with leases. You can back out of a deal, or you give some time to say, what the hell was I thinking? And so the idea about a 3-day rule is, say, when you have a big move of some kind, typically it's down, right? People are like, don't rush in and do something. There's an expression out in the West, right? Let the dust settle, right? You see who's alive, whose gun's loaded, who's not loaded. So you don't have to, after a big drop in gap, jump in. Now, is there a magic to 3 or waiting for we have to pick some day. Is it 5? Is it 7? So 3 is convenient, but there is no magic to waiting.
All right. Well, here's why I'm asking this question. I'm going to put a 1-year chart of PayPal up. Okay. And I'm going to be really clear with you people. So like oftentimes, and Carter, you're with us all the time. It's 5:15 p.m. and it's earnings season, and a company reports their earnings and the stock moves and we have to react, right? And so PayPal was interesting. Okay. So this was back in early May, and I was on the desk of Fast Money, and, I was not long the stock into the print, but the stock was trading, I think at 70 or something like that. And I was like, I'm just going to buy it on the opening. Okay. So if I had waited 3 days, I would have gotten a good price on this one here. Okay. And I had to average in a little bit. And then, I kind of I wiggled out of it. I had to trade my way out of it. That's not a great place to be here. But look at where this thing is now, Carter. And I'm just curious, there's the 150-day. It's just above that. But literally look at that resistance line is to the penny. And then I just want to pull up a 5-year or 6-year, which I think you probably care less about. I could have drawn a line there. What does this thing look like to you here? I'm just curious. Maybe we'll go back to that 1 year for a second here, because my point was just on valuation, and I didn't think the quarter of the guidance was that bad either. And it was just interesting because it looked like a couple very large sellers were just saying, get me out.
Right. So in principle, I would characterize the current circumstance as a rally to a difficult level, right? You've moved from essentially 60 to 75, up about 25, 26%. But more importantly than the percent or the actual level, it's the level from which it dropped in gap. So you're back to the scene of the crime, right? This is the stock that, as you articulated, that plunged on the 9th of May. And before a stock plunges, anyone who purchased the day before, they didn't buy it because they wanted it to plunge or thought it was going to plunge. They bought it because they thought it was going to go up. And anyone the day before that and the day before that, point being, there's 2 to 3 months of purchases made just before it plunged. Now, we're back to that level. So there are people who now have a chance to recoup all losses, get all their money back, and that is what overhead supply is. And of course, there's supply from below too. Someone, dumb luck or brilliance, bought it at 60 or 61 or 62. Well, when you flip the cards over and show that person 73, 74, they're like, man, I just gambled on PayPal. I bought it at 62. It's 72. I'm going to grab this. And so what is this? It's a rally to a difficult level where supply emerges from all sides. If I had this, I would trim or sell.
Dan, before we get out of here, either you or Carter, anybody in the audience, if I said the name Leo Balmuto, anybody? Dan,
Nothing.
Carter? No. Maybe somebody in the audience will know that and without Googling. But I'll tell you this. Carter said something about the rules, and he said there are no rules. If you're calling the movie Grease at the end when they're doing the drag race, Leo Balmuto says to John Travolta, the rules are there ain't no rules.
There you go.
That's a solid.
Well, hold on, Guy. I gotta interrupt. I gotta interrupt for a second. A much better iteration of that, okay, and this came out before Grease, was in the beginning of Butch Cassidy and the Sundance Kid. Remember when the guy comes up to him and says, you know, you always said, Butch, that if anyone wants to challenge you to run the gang, and he goes, guns or knives, Butch? He goes, I don't want to fight with you, Harvey. And he's like, knives, right? And then he's like kind of meandering over to him, and he says, all right, well, what are the rules? He goes, rules? There's no rules in a knife fight. Okay, well, let's get it started. And he punches him, like kicks him in the nuts, punches him in the face, and the fight was over, right? Like that's
one of the great movies. Listen,
movie.
one of the great, Paul Maloney, who watches our stuff fastidiously, great word, was good friends with Paul Newman. As a matter of fact, there was recently a Paul Newman auction. That Paul bid on some stuff.
Like he had like a great Rolex collection.
Yeah, Paul Newman. I don't know. I will tell you, there have been some cool people over the years. Steve McQueen, clearly a cool cat. Obviously, you look at a guy like Charles Bronson, just a cool cat. But Paul Newman, my God.
Yeah, the coolest.
Cool cat. Coolest. And so are you, Carterworth. And so are you, Dan Nathan. And so is our audience. But that's it for today. Now, before you leave, I'm just going to tell you right now, if you dig the On the Tape podcast, by the way, you can find us in your favorite podcast store. It drops on Fridays. Danny Moses of The Big Short will be joining us for the full hour this evening on CNBC's Fast Money, along with Cameron Dawson. It's going to be a fun show. Dan is back from vacation tonight on Fast Money. We're all at the NASDAQ. But that's it for today's market call. I want to thank our sponsor, CME Group, Dan, where risk meets opportunity. Of course, Carter, FactSet, financial data and analytics powered by tomorrow. We will see you tomorrow, a Wednesday. Later.
See ya.